In our latest video on how to avoid UK tax legally, we look at expenses that landlords can incur to reduce their tax liabilities on rental income. If you let out a property, you can deduct the business expenses that you incur when working out your taxable rental profit. Here we look at 10 popular expenses that you may be able to deduct. 1. Letting agency fees. If you let your property through an agency, you will be able to deduct the fees charged by the letting agency. These are typically a percentage of the rental income. 2. Advertising costs. You may advertise your property in order to find new tenants. The advertising costs are allowable business expenses and can be deducted. 3. Accountancy costs. You may use the services of an accountant or bookkeeper. These costs are allowable costs which can be deducted. 4. Cleaning costs. If you use the services of a cleaner, either for in-tenancy cleans or end-of-tenancy cleans, or to clean your office premises, you can deduct the associated costs when working out your taxable rental profits. 5. Gardening costs. If your property has a garden and you incur gardening costs, you can deduct these in calculating your taxable profits. 6. Travel expenses. Any costs that you incur in relation to your property rental business are deductible. This will include costs of visiting the property to check the property, visit the tenants or undertake maintenance, and any other travel costs incurred wholly and exclusively for the purposes of the rental business. 7. Repairs. You can also deduct the cost of repairs that you need to do to the property or the cost of any fixtures and fittings. 8. Replacement domestic items. If you let a residential property furnished, other than as a furnished holiday let, you can deduct the cost of replacement domestic items, but not the cost of the original items. The deduction is capped at the cost of a like-for-like replacement. 9. Utilities and council tax. In a residential let, the tenant will normally meet the cost of the utilities and the council tax. In a holiday let, the utility bills and council tax business rates, where applicable, are usually met by the landlord. Costs of this nature met by the landlord are allowable business expenses. 10. Interest and finance costs. Although residential landlords cannot deduct interest and finance costs when calculating their taxable profit, relief is available for 20% of those costs as a tax reduction. Non-residential landlords and those letting furnished holiday lets can deduct interest and finance costs in calculating their taxable profit, as can corporate landlords. And now to our bonus tip. Landlords affected by the restriction of their mortgage interest claim may have noticed a box on the 2020 tax return which said Box 45 Unused Residential Finance Costs Brought Forward. Completion of this box records the amount of interest that has not been utilized in 1 year to be carried forward and to the finance costs figure of the following year. The tax reduction for that following year is then calculated using both the amount brought forward and the current year's finance costs. If you require assistance in calculating and utilizing the unused residential finance costs, then please comment below.